We finished 2021 with an inflation rate of 7%. That's the highest it's been in like 39 years. We try to keep inflation at 2%. And then it didn't stop there. Look at 2022. We've seen inflation go as high as 8.5%, people. And tomorrow, we're expecting it to hear inflation still be above 8%. What's up, everybody? Welcome to episode 22 of Bag Talk. Today we'll be discussing this bloody stock market that has been so painful to be a part of, and we understand your pain. But we're also here to deliver you some understanding. We're going to help you understand why the stock market is like this and how you can make your situation better in the markets. But speaking of pain, my brother Nuski is going through some real pain right now, people. You want to explain?
Yeah, so I got both my wisdom teeth pulled out yesterday, so that's why I'm talking low right now. I can't really yell in y'all ears, but I understand what Kanye's been through now. Through the wire is a real thing. I'm here for it. I can't really open my mouth right now, so Raul's really going to have to put the team on his back, but we're going to try our best to explain to you everything we can so you know what's going on.
That's a fact. And Through the Wire is one of my favorite Kanye songs. Probably his best song, first of all. But back to the markets, bro. So why did the stock market get this bad? Because just not too long ago, it was looking fire, right? It was green. Everybody's making money. Now everybody's losing money. So explain how we got here in the first place.
So let's kick it back to 2020, right? This is where everything started, essentially. So obviously something called COVID hit, which was really bad, right? People lost their lives. It was a terrible time period. But this also impacted the financial markets, right? You saw a lot of red in the markets. You saw people losing their jobs. You saw businesses shutting down. It was bad in general.
Yeah.
So what the Fed decided to do was step in to help the market by one, decreasing interest rates to 0%. So what this means is that businesses are not actually paying as much now when they borrow money, right? Two, they said that we're going to print a lot of money to help people who can't afford rent anymore, people who are actually just homeless right now. And with all this money being printed, well, this actually leads to inflation. But back then, no one cared about inflation, right? It was just not a thing. We wanted to survive. Now, Morgan Stanley actually came out and said in 2020 that because of all this money being printed, inflation is going to be a thing. They also showed this chart which says how much money was printed in 2020 versus all the other years. As you can see, it's a very, very big jump. Yeah. Now, something else that happened in 2020 because of COVID was supply chain, right? Since COVID impacted the entire world, China was hit pretty hard. And since they're the largest manufacturers and they actually supply us with a lot of the material we need to build things, they couldn't supply it to us anymore. Since they can't supply it and the demand is still high for stuff, we're in a very tight situation because that actually means all the product is more expensive, which is really what inflation means. So that whole picture in itself is not a good thing because it led to a lot of turmoil in current markets. So let's just explain to them what quantitative easing is and what inflation actually means.
Yeah, so first let's start with inflation, right? So as you mentioned, inflation is when they print so much money that it devalues the currency, therefore prices go up. Like we said, prices also went up not just because of printing, but because of the supply chain, right? And so this continued in 2021. Supply chain is still bad. We can't get materials from anywhere, not even just China, around the whole globe. So it's still bad. And we got Jerome Powell, the head of the Federal Reserve, saying, yo, don't worry about inflation, guys. It's nothing, man. It's temporary. It's transitory. Please. That boy is cat, bro. He a liar, man. It was not no transitory inflation. This was a real issue, y'all. An extremely real issue because we finished 2021 with an inflation rate of 7%. That's the highest it's been in like 39 years. We try to keep inflation at 2%. And then it didn't stop there. Look at 2022. We've seen inflation go as high as 8.5%, people. And tomorrow, we're expecting it to hear inflation still be above 8% when they bring out the reports tomorrow. So it's rough right now. But I don't want you to think this never happened before. Understand, if you look back into the 80s, we've been in a similar situation, potentially even worse back then, because inflation in 1980 hit as high as 12, 13, 14%. All right. And then in order to combat that high inflation in 1981, they had to increase interest rates to as high as 21%. So I want you to notice something, right? When the economy was struggling, COVID hit, Nuski told y'all that the Federal Reserve decreased interest rates to stimulate spending. We spent so much freaking money, then it caused a high inflation. So to combat high inflation, they had to increase interest rates. Okay, and so that's what we do to combat inflation, and then here we are today.
Exactly. So now you see the Fed is actually saying, yo, we're going to stop printing all that money, right? We're going to literally tighten everything up, and we're going to increase interest rates, as you just said. Well, we've already seen an interest rate hike of 0.25 and 0.5. And the Fed is not saying that we're stopping anytime soon. They're actually saying we're going to they're actually saying that we're going to actually increase interest rates even more in the upcoming months. So this is actually about to be pretty bad, because now we're just paying more money to borrow the money that we were doing in 2020.
Facts.
So this is not good news, but it doesn't mean it's bad, right? Like they have to do this because inflation is so high. Like the banks can't just sit there. The Fed just can't sit there and be like, yo, we're going to let inflation go as high as possible.
Definitely not.
This is the action they have to take. So we want you to understand that they're just not doing this randomly, right? This is something you have to understand. Mm-hmm. But I know I said something about they're going to stop printing money. So that refers to quantitative tightening. So explain that real quick.
Yeah, so quantitative easing, first of all, is when they were providing money to everybody, right? And they do that when the Federal Reserve buys bonds from the banks. That means that they're giving money to the banks, right? And so therefore the banks have money and they put loans out, right? They provide money to us. Now, quantitative tightening that Newski's referring to is the opposite of that. This is when the party's over. We're not getting as much money anymore, right? So they're drying up the money in the economy. And they do that because they have to combat inflation. Mm-hmm. So because if they don't do that, we're all gonna have so much money and we're gonna keep spending and spending and spending and spending. So they do quantitative tightening to slow that down. It's not the first time they've done this. Mm-hmm. Right? They had to do quantitative easing and tightening to get us out of the 2008 recession. And so they're doing it again to get us out of the 2020 potential recession.
Exactly. So not only are we worried about finances, right? And we explained to you supply chain is a part of this, but this is different than other markets because we have a global problem as well. When I'm referring to Russia and Ukraine, there's a lot of stuff that's happening over there because if a war happens, it's going to actually impact the U.S. and other countries around it, right? So that means if we're in war, interest rates are going up, you have a supply chain issue, and people are losing their jobs now. Because we just saw what happened with Robinhood. We've seen what happened with Better Mortgage. We've seen what happened with Netflix. This is not good news. Like, this is actually bad news. Yeah. So that paints you guys a total picture of the past and the present. So now you guys have an understanding and you guys are not lost on why this is occurring. Because I know a lot of times people just are like, what's going on in the markets? Mm-hmm. Now you guys understand that this is just not random. Everything is really a cause and effect relationship. So now you guys understand that. So I think we've scared you guys enough and gave you guys enough information. Let's talk about our opinion and what we're going to be doing and what we think you should be doing. We can't tell you what to do. We're not your advisors, but, take that off.
Yeah, man. So in 2020 and 2021, we saw the stock market so green, right? Everybody was lit. And that's because even businesses that were not profitable were still getting money from investors because everybody had money. So they were investing in risky things. You've seen companies like a DraftKings run up. DraftKings, their net income is negative, like literally negative. They don't really make money for real, but they got money from the stock market. And so now in this time period, investors, especially investors with a lot of money like hedge funds, they're like, yo, we're going to take our money out of companies like a DraftKings or companies that don't really make profit for real. And we're going to put it into companies we can actually rely on. You know why? Because we're playing hardball now, right? We went from high school basketball to the NBA, right? Because guess what? This is not a low interest rate environment anymore, right? This is where the real companies are going to thrive. And so hedge funds and everybody, they're reallocating their money out of these growth stocks that we've grown accustomed to being a part of. So I know you've seen certain companies drop 80%, 90%. It's bad out here. And you see the best companies, they've been able to maintain their position a lot better. Don't confuse a company that everybody uses with being a good stock. Just because people use it doesn't mean it's a good stock. Like Lyft or Uber, right? They're bad stocks. They're actually not profitable. So what you have to do is look at your stocks. Go through your analysis. We put out a video on this in Rookie Mondays where we told you how to analyze a stock to know which one is good for you, what's a valuable stock. A lot of these companies that we've been invested in the pandemic are actually not good companies. So you want to make sure that in this time period, you're invested in great companies. And I know you wanted to mention some great companies they could look into.
Yeah, and I mean, before I do that, I want to make sure y'all understand what he just said because it was pure gems, right? Just listen to it. Like hedge funds, and actual big institutions are the ones who control the market. Like
Facts.
we don't control the market, y'all. So when you see people investing like $10,000 or $20,000, that's cute money. But like hedge funds and institutions are losing 10 billion, 10 million. You know, it's a lot of money. So the fact that they're rotating, right? It's literally like if you play basketball, just think about pivot. Like you're a big man, you're pivoting, bro. Like they're gonna pivot out of the growth stocks that made a lot of money during the pandemic now into value stocks, because we've already said it. Interest rates are going up, which means it's hard to borrow money. So all the growth people who have terrible balance sheets are going to fail. So that's what he was referring to when he says go to value stocks. So ones that we want to talk about are the best companies that are in the world, right? Like Amazon, Google, Microsoft, Apple. Yes, these companies are down. Some of them, I think Amazon's down 36%, right? When you look at it, although they're down, are they as down as the other growth stocks we're referring to? Hell no, right? Like the S&P 500 right now is also down. But does that mean the top 500 companies are going to fail? Nah. It just means that this is a discounted price if the company is a good, credible company. They have good balance sheets. So when you're looking at the stocks that you want to invest in, just evaluate the actual good stocks to see if it makes sense for you, right? If you're not into stocks, which honestly 99% of you shouldn't really be into stocks anyways. It should be about ETFs. Invest in ETFs in sectors that you like. And if you don't know what an ETF is, can you explain it, bro?
Yeah, it's when you can buy into a fund that holds a bunch of companies. So for example, let's say I think that semiconductors are the future. I can actually type in semiconductor ETF and find funds that invest into all the best semiconductor companies. So it's hard to choose individual companies. So buy a fund, right? Buy that ETF, that exchange traded fund. Right? And so I know you were speaking on these value companies. Even companies like Amazon face a little turmoil lately because guess what? They're feeling effects of the supply chain. Amazon's having a problem with supply chain. Even Apple's having a little bit of supply chain problems. They said that in their earnings report and their guidance that they gave. And so if the biggest companies are having problems with like supply chain issues and stuff, what y'all think's gonna happen with the little guys? So that's why you see so much red in the markets, because these hedge funds and these investors are saying, yo, we got to get our money out of these companies that we can't rely on and get it into some better positions. And so that's why the markets are so red. They're just reacting to everything. Every time they talk about an interest rate hike, they're like, oh, nah, the pressure's still on. Let's get about these companies.
Exactly. So that it really is explained to you guys what you should be doing, right? Once again, you guys are investors. If you follow the Bad Talk Show, you're not gamblers. You're not just random traders. Y'all are investors. You want your money to grow. So put it in good, valuable ETFs, good, valuable companies, and you will thank yourself during this tough time, because millionaires are made during a recession. Warren Buffett himself said it. Be greedy when others are fearful, and be fearful when others are greedy. So do what you want with that information, because we're not Warren Buffett, bro. But at the end of the day, if you're still watching right now, we appreciate you. Thank you. Make sure you like, comment, and subscribe to the channel, and hit that notification bell, because we drop
2 videos a week.
and you do not want to miss them. I appreciate you guys for dealing with my voice right now. Make sure you check out Rookie Mondays. But until then, peace.
Peace.